Well, hello and welcome to this Moneycontrol live stream. I'm Nandita Khemka and you're watching Morning Trade on Moneycontrol. Over the next 30 minutes, we'll be talking about the trade setup, some of the stocks in news, as well as answer your queries with our experts on the show. So if you have any queries, keep commenting on our live feed and we will have them answered by our expert. But before we get our guests on board, let's take a look at what the global handover is looking like this morning. Well, Wall Street rallies with the Nasdaq clocking its fourth straight day of gains ahead of the release of December CPI data today. Asian markets largely higher with the exception of the Nikkei. The SGX Nifty too indicates a positive start for the Indian markets. Key IT earnings today. Infosys expected to report dollar revenue growth of about 1.5% in the third quarter while maintaining its revenue guidance. HCL Tech's revenue growth is seen at 3.5% in what is considered a seasonally strong quarter for the company. Also on the show today, defense stocks are abuzz as the government approves purchase of defense weapons worth 4,300 crore rupees. So how should you play these stocks ahead of the budget? Also stocks in news today are Infosys HCL Tech and HUL. Well, let's get our guest on board then. Joining me is Gautam Shah of Goldilocks Research. Good morning, Gautam. Good to have you on the show. Well, if you look at the markets, well, 2023, I beg your pardon, has not been a great start for the equities. We've given up those 18,000 levels. We are down somewhere around 1,000 points from record levels. And even though global cues have been supportive over the last 3-4 days, we've been ending in the red. Monday, we saw the markets reclaiming the 18,000 mark, but we didn't really manage to sustain those levels. And today as well, the SGX Nifty is hinting at a dash of that 18,000 mark. But should such moves be looked upon as a flash in the pan or a dead cat bounce, or do you expect such levels to sustain in the weeks to come?
Good morning. Yes, I think to a certain extent, India seems to have lost its outperformance because I think the whole of last year, you had a very weak global market environment. And despite that, I think Indian market stood out really well. In fact, it was the only market in the world that got let off with a very small cut of about 10, 12, 15%. And most other markets in the world lost anywhere between 15 to 35%. But I think if you look at what has happened in the last 4 to 5 weeks, as you rightly pointed out, I think there is clearly underperformance which is coming back to a certain extent because global markets have been extremely steady, Asia, Europe, US, and despite that, Indian markets have seen a very large fall and a lot of the large caps have come under pressure. So if you really do a ratio chart check, which is India divided by the emerging market basket or India divided by the world, you will see that, that's looking like it's topping out. So I think we are in a sort of a in a range, and this range is likely to break on the downside. I think the range is very clear. 17,800 on the downside, 18,300 on the upside. We have been oscillating within this range from one band to the another for the last few weeks. I think this is distribution. Eventually, the chances of 17,800 breaking is quite high. And once that gets confirmed, you could see another 4-5% on the downside. So we are actually working with a cautious stance for the short term. Only past 18,300 will our view on the markets change. Otherwise, I think, we could be in a difficult space for some more time, till the budget at least.
Well, cautious is the stance on the markets. That's what Gautam is saying. Gautam, stay on with us. I will just come back to you. But before that, I want to discuss some of the moves on some of these defense stocks. For that, let's bring on board our guest for that. Mr. Amit Kumar Gupta from FinTech Capital joins us now. Good morning, Amit. Good to have you on the show. These defense stocks saw a stellar run in the last year, and this year as well we've seen some positive news coming in for the sector. So how should one go about playing some of these stocks like Astro Microwave, Bharat Dynamics, etc. before the budget?
Yeah, good morning, Nandita. Thanks for having me. I believe that the defense sector is still favorably placed given the opportunity sized both in the domestic market and the export market. And its potential growth over next 2 to 3 years at least. And the recent conflicts closer to India, Europe, and other parts of the world have actually strengthened that urgency and the need to increase capex and localize production, which made the sector attractive to investments. As far as the stocks are concerned, we need to understand how much of the earnings are front-loaded into it. Anytime, our sector moves so fast in a very short period of time, like we saw in the last 3-4 months of 2022, the sector or the stocks would like to take a pause and catch up with the earnings. But I believe as we have seen in the recent conflict, that the importance of the new defense equipments that coming up is has improved a lot, and the defense ministry has on the pipeline of almost 84,000 crores of these proposals which are there, out of which about 40 to 4,300 have been approved this week itself. So I think the pathway is along for the next 2 to 3 years, but in the short term we might just consolidate.
Sure, consolidation on the cards for some of these stocks. Well, Goldman Sachs came out with a report, and there are expectations of a higher outlay in the budget towards the defense sector once again. What are your own expectations from the budget when it comes to this sector?
So I think the expectations are actually already laid by the government itself when they have said that we want to do 35,000 crores in exports by FY25, or we want to clear these 84,000 crores of total proposals by FY25. Now, my major point in the budget is that if India wants to become a net exporter in defense, then India needs to invest more in its R&D. It needs to follow up a bottom-up approach to decrease dependency on the foreign parts and provide more incentives to companies in the coming years. They are already providing some sort of incentives to the PSU companies, but I think those incentives will come more towards the private companies just because of an efficiency arbitrage. So I think the overall R&D budgets needs to go up, and what I like to see in the upcoming budget is that India spends more on its defense budget. Currently, I think India spends around 6% of its budget on R&D, whereas if you take any of the top manufacturers like US or China, they are spending 12% and 20% respectively. So I think India can do much better by allocating more of its resources into R&D if it is serious about the Make in India plans. So that is one part. And secondarily, I also expect that governments will extend a lot of these PLI schemes for defense equipment manufacturing and offer incentives to domestic manufacturers more. So that could be in the form of tax holidays for new investments. That would sort of motivate the existing players to do capex and expand their activities and make new investments.
Sure, Amit, thanks a lot for taking out time and sharing your thoughts with us this morning. We look forward to having you on the show once again later sometime. Well, with that, let's go back to Gautam and discuss some of the stocks and sectors that are in the news this morning. Gautam, I want to come to you on the IT sector. DCS reported a fairly stable set of numbers in a seasonally weak quarter, and today we have Infosys as well as HCL Tech reporting their numbers. IT has been an underperformer last year on concerns of global recession. HCL Tech, in fact, had lowered its guidance last, and that's what will happen. The revenue will be coming in at the lower end of the guidance. Given the fact that the TCS CEO in a conversation with Moneycontrol had said that double-digit growth will come back to the IT sector soon enough, would you say that it's not all gloom for the IT sector, despite the fact that growth is slowing down in the US? So in the backdrop of all this news flow, what are your thoughts on the big three, HCL Tech, Infosys and TCS?
Well, I think it's already been very gloomy. I think if you look at 2022, most of these stocks have already lost about 40-45% just like that, without the lack of any news flow. And I think most of the negatives, which people have been discussing for the last 6 to 8 months are now in the price. So whatever the news flow is now and whatever the results are, I don't think the stocks are reacting too badly. And I think TCS just put that out. So I would not be too negative, but at the same time, given the market setup and given the kind of momentum that the IT index has currently, I don't see short-term strength. So I think it might just be in a range. And if the Nifty were to fall, and break support levels, which is my view, then IT might just stay in a longer range. But if you have the patience and if your time frame is, say, 6 months, 12 months, 18 months, then I think the top 3 stocks, Infosys, TCS, HCL Tech, and even a Wipro, I would like to add a Wipro as well, are probably very good investable names at these prices, because I think the risk reward is excellent. Most of the negatives are discounted, and I think it can only do well from here. So downside potential is about 5, 7, 10% max to max, but the upside potential is far greater. So as investors, you should be looking to top up.
If you have patience, look to top up when it comes to these big IT names. That's the call from Gautam. Moving on to the banking pack, we know that banks took the leadership last year. In fact, particularly the PSU banks had a fairly good run last year. Even yesterday, when the setup was weak, we saw the Nifty bank holding up and gaining to the tune of 0.5% or thereabouts. So, for this year, what is your outlook on the likes of SBI, PNB, and Bank of Baroda?
Well, I'm not too positive on the banks anymore. In fact, I was a very big bull on it the whole of last year, and the bank Nifty was the reason why the Nifty did so well. It went on to hit new lifetime highs at 18,900. But if you look at the price action of the last 2.5 weeks, the bank Nifty has quietly come off about 7% from the highs. It has underperformed to a certain extent. Many of the top banking stocks are looking quite weak on the charts, and now it's at a make or break point. So if the bank Nifty breaks 41,700, we made a low around this number yesterday. So if you break 41,700 on a closing basis, then the bank Nifty can actually lose about 5, 7, 10%. So the charts are not in great shape. If you look at the weekly and the monthly charts, I don't want to get into the technical figures, but most of these charts suggest that there could be a leg down, and the banks could be responsible for the Nifty to move lower. PSU banks, I think, clearly have been the hot topic for the last 6 months. They've already run up a lot. I think it's a little over-owned now, overexposed. Too many people talking about it, trying to make money out of it at these levels. But I think it's just too extended to do well from here. So if you are long from lower levels, the advice to your viewers is to take profits with a view to buy back lower. Rather stay with the big private names. I think there you will find a lot more stability. So ICICI Bank might underperform in the short term, but if you have a slightly longer term view, then ICICI and probably Axis and IndusInd are the better bets, and HDFC Bank to add to it.
So private sector is where the value would emerge going forward. Also talk about the FMCG basket. This pocket has also been under pressure. Price hikes and a fall in input costs may support margins for some of these companies in the quarterly earnings. But what could play spoilsport is the recovery, the slower recovery in the rural demand. So how would you look at the likes of HUL, ITC and Marico, for instance, going forward?
See, it's quite interesting that just ITC, one stock led the entire gains for the FMCG index. And now as that stock has lost its way to some extent, the FMCG index is looking like a different animal altogether. Because apart from ITC, if you look at all other stocks, whether it's a Dabur, Marico, Godrej Consumer, United Spirits, and obviously HUL, they haven't done so well in the last 6 months. They've just been languishing in a range or correcting. So the points that you alluded to from a fundamental standpoint makes a lot of sense. And I think it's going to put pressure on the FMCG index going forward. So it's clearly not our favorite. I think there is room to fall because the whole of last year on an index level, FMCG did well. But still, our favorite is still ITC. I think if you have a 3-year, 5-year perspective, any dip towards, a 5% or a 10% dip on ITC towards 300, I think is a great buying opportunity. So I think that's really the story of FMCG. Stocks like HUL are just in a range. And I think any which way we found out that in today's market, anything that is richly valued, and doesn't give you a sort of a dividend yield doesn't do so well. And those are the kind of stocks that are coming under pressure in the recent past.
ITC is emerging as a good pick in the FMCG basket. Let's also talk about Reliance Industries. Lots of positive news coming in on this stock over the last few weeks. Can the stock hit 3,000 levels this year?
You know what? I was very optimistic the whole of last year that at some point of time it will break out and go towards 3,000. But I think there were 7 or 8 attempts that failed on the upside. And even when the Nifty went towards 18,900, the stock refused to get past 2,700. So now we are starting to believe that maybe what has happened in the last 1 year was not consolidation and actually distribution. Because when a stock doesn't perform in the good times, it usually becomes the punching bag in the difficult times. So I'm a little concerned about Reliance. And if you look at the outperformance of Bharti vis-a-vis Reliance, I would rather be more comfortable with a Bharti over Reliance. So I think Reliance 2350, 2750 is still the large range. There's no point committing capital because this range can continue for months to come. But with my market view being negative, the chances of a breakdown below 2350 are higher. So I think I'd rather stay away from the stock for this time being.
Right, stay away from Reliance Industries for the timing. Since you alluded to Bharti, we saw that stock lose somewhere around 6 to 7% over the last 2 sessions. We have had brokerage reports also coming out saying that there's a lesser probability of a price hike in the calendar year because the focus would probably be on customer onboarding after 5G launch. What is your short-term view on Bharti Airtel going forward?
See, most of the large cap stocks which have done well in the last 6 months have come under pressure. And I think that's clearly a trend that we are witnessing. Maybe the FI selling is happening in some of these stocks which have done very well. And I think it's okay for people to be taking profits because, India seems to be losing its outperformance to a certain extent. Short-term Bharti can be under some more pressure because it's been a very knee-jerk kind of a fall that has taken place. Another 5% downside is possible. But again, if you're somebody who's building a long-term portfolio, looking at things 12 months, 18 months down the line, Bharti on any further dip, I think is a very good buy. Excellent long-term structures, doing all the right things. It's not a high beta stock. It can do well in difficult times. And it's not, I would say, overly exposed and overly owned.
Well, Bharti is a buy on dips, according to Gautam. Let's now shift focus to some of the queries that we are getting from our viewers. The first one I would like to take up on Titan. It's coming in from Prabhu, and he wants to know the short-term and long-term view on this stock. Now, Gautam, this stock has been in a steady downtrend over the last 1 month. What would you advise investors to do for the short as well as long-term for this counter?
Doesn't look good. I think, as I said, many of these high flyers of the last 1 year, are just coming under pressure. We've seen what has happened to Bajaj Finance Finserv. We've seen what has happened to Asian Paints. These were the poster boys, Jubilant Foods, Loris Labs. All of these poster boys of the last couple of years are coming under pressure, and Titan as well. I think the short-term chart setup is weak. I wouldn't be surprised if it gradually move towards a level of 2,300 and maybe even lower. But the only positive I see is if there is a rub-off of a move in international gold prices, because I'm very, very bullish on gold and silver, and I see them doing well over the next 12 months. So that could be a long-term, benefit because there is some sort of a correlation. So short-term, I think no trade, stay away, do not indulge in bottom fishing, let things stabilize. But closer to 2,300, maybe the long-term positive triggers kick in.
Okay, closer to 2,300 long-term gains could kick in. Since you alluded to gold and silver, Gautam, I would want to ask you one question when it comes to the outlook for this year. Do you think the theme this year would be commodities, given the fact that metals have been doing well as a basket, especially after the China reopen theme?
Yes, I think so. That's what it looks like. And I think precious metals are right up there. You must have seen the excellent move on gold from 1720 to 1880 levels. Even silver is at $24 as we speak. And I think there is room for 20-25% upside, which I don't see coming from equity markets. So I think equity markets in general this year are going to be in risk-off mode. So you have to be a stock picker. You have to look at things bottom up to actually outperform the benchmark indices. But in this environment, if you're going to allocate 10-15% of your portfolio to gold and silver, you'll actually stand out. So yes, in a sense, it looks like it's going to be a year for commodities, but within commodities is a very large basket. I think I prefer precious metals over anything else.
Right, precious metals will be emerging as a theme for this year. Let's also get in a view on Naveen Fluorine. Suraj Mandal has written in and he wants to know your views on this one. Over the last 1 year or so, it has lost somewhere around 6 to 7% or so. What is the chart suggesting for this counter, Gautam?
See, the entire chemical space seems to have lost its mojo. I think it was the best performer in 2020 and first half of 2021. And thereafter, I think if you look at the last 6 to 8 months, the Aarti Industries, the SRFs and the PI Industries and the Naveen Fluorines of the world, they haven't done well and they will stop moving with the market. And I think because all of these stocks are very richly valued and most of the positives are already in the price, and there is this big China factor, which is an overhang all the time, and also the fact that it is overowned, I don't see them doing so well in the near term. And because the rise was so large over the last couple of years, the scope to fall even from these levels are pretty high. So it might be trading at about 3,900 today. I think there is room for another 5, 7, 10% downside. So don't indulge in bottom fishing in the entire chemical space. If the markets come under pressure, they will be losing a lot more ground.
Right. Moving on to another query on the diagnostics space. From the diagnostic space, Baswaraj has written in. He wants to know your views on Thyrocare, which he had purchased at an average price of 767, and he's incurring a loss. So he wants to know whether he should exit it or average it out. Remember, these diagnostics stocks had seen quite a bit of a run when there was news coming out of China that there's been an explosion in cases, and there were concerns that we may see a resurgence in COVID cases back home. That is the time when we saw a rally coming in on some of these diagnostic names, and Thyrocare was also one of them. But going forward, how are the charts looking for Thyrocare?
Some of these names have become very cyclical in nature. They go through their uptrends, they suddenly abruptly change their trend, and then they get into a downtrend and they lose all their gains. That's what has actually happened with Thyrocare and the Lalpath Labs of the world, Petropolises of the world. They were such solid names, which had wonderful trends in the last couple of years, but now they just seems to have lost its way. So I think this viewer obviously has bought it at very high levels. But at these levels, you can't be selling out, because I think you've gone through that pain, and hopefully you will not see much more pain from current levels, because most of the negatives are already in the price. So I think the best advice here would be just hold on, maybe look to average at lower levels when we start feeling that the market is going to stabilize. But the important point here is, in every sector, you have a big outperformer and a big underperformer. The advice to your viewers is to stay with the big boys, stay with the names which are outperforming. I mean, look at a Narayana Hridayalaya or look at a Apollo Hospitals. They have been doing so well in comparison to some of these other diagnostic names. So for Thyrocare, just hold for the time being, wait for things to stabilize, and then maybe, on any pop, we look at an exit.
So hope that answers your query, Baswaraj. Moving on to some of these Adani Group stocks. We first saw a stellar run on these stocks, and now they've come under pressure. So Yash Mahankar has written in, and he wants to know your views on Adani Power. So how would you view some of these Adani Group of stocks on the charts going forward?
I think it's overdone. I think it's the best could be behind us. We've actually initiated a negative view on the entire Adani Group stocks in the last couple of weeks. And the way I read the charts, the weekly and the monthly charts, I think the upside potential is just not there. And the downside room is quite substantial. I know there is a frenzy to go out and buy Adani stocks on every dip. This strategy has worked in the last 18 months, but it might not work anymore. So it's a very clear advice to all your viewers that stay away from the Adani Group stocks just for the time being, because the overall market setup is not the best. And if 17,800 on the Nifty breaks, then Adani Group stocks will actually come under pressure. Just let it be. Stay in value names. Stay with stocks that give you the dividend yield. Stay with the PSU basket. Stay with capital goods. Stay with pharma to a certain extent. Adani Group stocks should be avoided.
Well, avoid Adani Group stocks at the current juncture. That's the call from Gautam. Gautam, my last query would be from the realty basket. Jawahar has written in, and he wants to know your views on DLF. How would you look at some of these real estate counters, given the fact that we have been witnessing a rise in interest rates, and interest rates are not going down anytime soon? There are expectations that RBI will be hiking rates by another 25 basis points in the February meeting. After that, it may be a hold, and then maybe they may look for a cut later in the year. So given the rising rate environment, what is your outlook on the real estate stocks?
See, for the last 6 months, the real estate index has been trying to do well, but it's just faltered at all rallies, which is not a good place to be in. But if you look at the DLF stock, I think it's outperformed big time, because if you compare DLF with Godrej Properties or a Lodha Developers, you'll notice that DLF has really stood out very well in this real estate index fall that we have seen. So long term, I remain extremely bullish. I think anywhere in this 350, 370 zone, DLF should be accumulated, both in DLF and Oberoi Realty. These two are our best picks from a longer term perspective. But short term, these are high beta stocks. They can't stand out in a difficult market environment. So let the storm pass over the next few weeks, the way I see it. And maybe post the budget, you can come back in and at lower levels, make commitments for 12 to 18 months. Don't look at 4 weeks.
Sure, there's a positive view coming in on the real estate basket. Well, this wraps up our query segment. But Gautam, before I let you go, would you have any recommendations for our viewers for the medium to short term?
Well, as I said, I think PSU is a basket which I like. The entire PSU basket, the way it's played out over the last 1 month, I think there's a bigger trend in play. So the Coal Indias and the top NTPCs and the power grids of the world, they all have very good charts. In fact, even in Oil India, ONGC, very good charts. In a difficult market environment, I think they will stand out. So I would recommend sizable commitment and increased commitment in the PSU basket over the next few months.
Right, PSU basket is where Gautam is bullish. Well, with that, Gautam, thanks a lot for joining in this morning. Look forward to having you on the show later sometime again. Well, with that, it's a wrap on this edition of Morning Trade, but don't go anywhere because coming up next is Opening Bell. Stay tuned.